Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, February 26, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, and if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will NVIDIA's results contribute to the U.S. growth scare? Our answers are the most important company in the world in this particular market cycle reports after the close today. Whether Jensen Huang can reassure investors that the world needs as many of his semiconductors as they previously thought when they capitalized his company over the past 2+ years is not something we have edge on. Apparently, neither does the market, because NVIDIA options currently imply a 9% swing in either direction. NVIDIA is down 6% year to date and 17% off its January 7th high. Bulls will say this is another buying opportunity, and perhaps it is. Bears will say the DeepSeek development permanently altered the demand curve for NVIDIA's chips, and perhaps it did. What we do know for sure is that the macro backdrop is less favorable than it had been throughout NVIDIA's bull run. Here's where we currently stand regarding the key macro cycles that explain the bulk of asset market performance relative to where they were when we turned bullish in January of 2023. Growth is worse, inflation is better, but it's likely as good as it gets. Monetary policy is better, fiscal policy is much, much worse. Liquidity is the same, and earnings are worse. If we focus on the bullish dynamics from that mix, we could paint a credible case for S&P 500 7,000 by year end, a third straight year of 20+% returns. If we focused on the bearish dynamics from that mix, we could paint a credible case for S&P 500 4,900 by the fall, which will be a 20% crash from last week's all-time high. This cognitive dissonance is why asset markets have been violently chopping sideways for months and may continue to do so if the current conditions of the key macro cycles remain unchanged. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding the U.S. services print. Says, hi, Skip. Regarding the U.S. services PMI that came out last week, should we be paying a bit more attention to how this unfolds? I always go back to your resilient U.S. economy theme, and one of the facts is that we are not as exposed to the manufacturing sector, and services was the key driver of growth. Is there any insight you could provide or thoughts, or should we watch how this unfolds? The price increases and prices paid point to margin pressures as well, playing into your sticky inflation theme as well. So thanks for the kind note. The first question is, should we be paid more attention to this? I think if you don't already analyze every major economic release from every major economy in the world in rate of change format on a daily basis, then yes, you should be paying more attention to this. I already do that. So no, I'm not paying more attention to it. I'm just paying the same amount of attention to it that I always do. So clearly, we flagged this, the slowdown in that services PMI, the slowdown in the New York Fed services sector survey. It's hard to take the University of Michigan survey seriously, but we obviously got the conference board print yesterday for February as well. So when you look at the compendium of leading survey data for February, it's pointing to a faster than expected deceleration in growth, both relative to our projections and Wall Street projections, which are actually more positive than our forecasted slowdown in U.S. growth. So this is something we need to watch because, this historically elevated policy uncertainty is very much contributing to a observed and realized, very noticeable slowdown in U.S. activity. We already saw business investment contract in Q4, but and very clearly starting to see that weigh on growth here, just from a leading indicator perspective here in Q1. So whether this transpires into something that's perhaps more than just your typical growth scare it remains to be seen. But I did want to highlight this chart here where we show the Baker, Bloom, and Davis economic policy uncertainty index. As you can see, the latest value is basically at an all-time high, with the exception of the COVID-19 crisis and the global financial crisis. And so, what I circled in this chart is the spike that we saw prior to the 2001 recession. So we have seen elevated policy uncertainty contribute to an actual contraction in the U.S. economy. Now, again, are we set up for a recession over the medium term? That is a low probability event. And what we mean by recession is your stereotypical business cycle contractive phase in the economy, whereby you have this sort of cascading series of events that ultimately winds up with, growth well below trend and negative, and inflation well below trend. Is that the most likely outcome? A standard business cycle, contraction or recession? No. But could we see a technical recession, much like what we saw in 2022? I think you have to have a serious conversation about that as investor if we see the weakness that we're starting to observe in leading survey data spill over to hard data in the month of February. And obviously, we're not going to get any real hard data for another couple of weeks. So we'll get the February jobs report, but the real data really start to come when we start to look at it on the consumer spending side and the capital investment side in terms of the middle of the week when we get retail sales and capex, and then obviously at the end of the month when we get personal consumption expenditures. If those data points point to a faster than expected slowdown that is currently being indicated by these leading survey data, then we got problems. We may have to start thinking about a potential technical recession, not a real recession. Please make sure you hear that correctly. We don't think a real recession is a high probability outcome over medium-term time horizon, but could growth do what it already did in terms of non-residential fixed investment, in Q4, which is, contract and grind to a halt and or contract? It could if policy uncertainty continues to be this high, because obviously corporations and consumers are struggling to adapt to the chaotic and frenetic pace of policy changes or potential policy changes that are coming out of DC and Mar-a-Lago. So definitely wanted to highlight the risks to the U.S. economy from the potential to all this policy uncertainty. It's already weighing on growth, and it may weigh on growth even more than us in Wall Street expect. And then let me go back to this. And just on the margin point, yeah, you were definitely seeing evidence of our sticky inflation theme playing out in the January and February leading survey data. We think on a reported basis, measures like core PC are probably going to be better behaved in, let's say throughout the balance of Q1 and maybe into Q2. But by the time we get into late Q2, early Q3, we expect core PC inflation to be in an uptrend, and that should be that should cause some issues for asset markets as it relates to the outlook for Fed policy. But the next catalyst from the perspective of monetary policy is probably going to be the Fed ending the Treasury portion of balance sheet runoff. So that's positive, but may not stay in terms of the monetary policy is positive, but it may not stay positive. So certainly when you get into Q3 and Q4. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, February 26, 2025. Hope everyone has a wonderful day. Best of luck, and we'll catch back here tomorrow. And just wanted to say happy birthday to my beautiful mother and happy birthday to my beautiful niece, Azaria. Hope you guys have a great day. May this be the start of the best year of your respective lives. Love you guys.